No intro, no music, just a moment of silence for everybody that shorted NVIDIA stock yesterday. All right, so just very quickly, I want to go over this NVIDIA chart because all year long, NVIDIA's weekly chart has been very bullish, starting out very strong in the beginning of the year. And as you can tell from the weekly chart, all year long, there has been no objective reason to short NVIDIA stock. However, bears continued to short this stock simply for the fact that it was going higher. And this is the danger in shorting a stock just because you think it doesn't have any more upside. This stock is now trading at all-time highs, which means you're going to have to start questioning of whether or not we're even still in a bear market. And as you can tell from the chart, objectively, we had stayed above the 5 EMA on the weekly chart and we were in a bull trend all year long. So there was just no objective reason to short this stock. And if you get in the habit of letting the chart and the price action do all the talking, you would have never tried to short this stock to begin with. So what's done is done. It's a learning lesson if you shorted this stock, and it's a constant reminder to let the price action, the trend, and the chart do all the talking. All right. So now let's skedaddle our way over to the SPY daily chart, and we could see SPY was up 0.87% today, and the price action is back above all the moving averages, and we still have the bull trend, and we did get the bounce off of that critical support zone right around 411. Now keep in mind, I'm calling this a bull trend until we start closing down below the 50 EMA on the daily chart, which is going to require a daily close down below 409. And this is still a giant trading range between 404 and 417. Remember, the price action and the chart need to do all of the talking, and right now the price action is above all the moving averages and we still have a bull trend, so both the price action and the trend are still bullish. At some point in one day this year, the market will roll over and lose the bull trend and go through a correction, and we know we have gaps to fill to the downside, but why not wait for the price action to confirm it instead of guessing? I just went over how that prevented you from shorting NVIDIA stock, and it's the same exact concept here. So again, if you're going to short the S&P 500, you're either waiting until we get to stronger resistance levels so you have well-defined risk, or you're waiting for a loss of price action below critical support to tell us we're starting into a downtrend. It's a bull trend until it's not, and price action is still above critical support, so we are going to assume that SPY is trying to go to higher prices, which is going to require that break back over 417 and then breaking above 420 to close these gaps above at 421, 425, and then above that will likely go to the August highs at 430. We are assuming SPY is going higher until we start closing down below 409 or wherever that 50 EMA is when we start closing below it. Again, this is still a textbook bull trend, which means after this higher low, we could still be going to put in a higher high. Just follow the trend and wait for price action to confirm we're breaking out of the trend, and then you can short like the wind, bullseye. On the NASDAQ 100 triple Qs, we were up 2.43% today with a monster gap up, so there's now going to be a gap down below at 333. So we still do have plenty of gaps to the downside, but as I said before, focus on the fact that we're in a bull trend and don't worry about those gaps getting filled until we roll over and die. As you can tell, the triple Qs are starting to get the first close above my critical resistance zone, which is between 337 and 339. And if we continue higher above this resistance, we are very likely going higher towards 350. Look at the volume on the triple Qs, and you can see it did exceed yesterday's volume. So if this was not just a short squeeze and we're actually getting organic buying above resistance, we are going to continue to climb to higher prices. If this was just a short squeeze, it is going to end up looking like a bull trap because we should instantly reverse and come back down to fill the gap at 333. So what I suggest you do is instantly get more risk off if we break down below this newfound support at 337, because below 337, we are likely going to fill the gap at 333. Again, only price action can tell us we're breaking down. We can't simply guess or assume we're going to 333 because it's possible we're still going to 350. Price actions above all the moving averages, we still have a very strong bull trend, which is evident with all of the moving averages with a positive slope, and we just put in another higher high after another higher low. There's still bears out there telling you the market's going to crash and sell in May and go away, but the chart continues to tell us to stay bullish. On the Dow Jones, we were down 0.08%, so we went absolutely nowhere, and we are still closing right on top of this critical support at the rising 200 daily moving average between 327 and 328. We're instantly bearish if we start closing below it because we do have the gap to fill below at 322. But if we bounce from here, we can actually start getting bullish with this as our risk level because this is critical support. A bounce from here means we're likely coming back up towards 332, and we're instantly a lot more bullish if we could break that critical resistance at 336. On the Russell 2000 IWM ETF, we were down 0.78% today, and we're starting to break down below all of the moving averages, which is confirming the bear trend, and we do have the gap to fill below at 171.56. This is is risk off below 176 because that is the critical support we failed to hold, which is now going to be critical resistance. So even if we bounce back up to 176, it's possible we fill the gap at 177, but it is also possible we get a lower high rejection until we go back down towards critical support. There's no surprise the small caps are weak because of all the regional banking failures and the high interest rate environment. And that is why you're seeing so much strength in the big tech sector. If we do get the bull breakout and continue higher, we'll be looking for the gap fill at 181. On the ARKK ETF, we were down 2.74% today, which is only confirming what I said a few days ago, that it was a great risk reward setup to short the ARKK ETF between 40.5 and 41.5 because we were still in a bear trend and we were testing critical resistance. This is just textbook rejection from critical resistance price action, so it tells us we're still in the bear trend and we're not getting bullish until we start closing above all that critical resistance. We do have gaps to fill below 36 and below 32. On the VIX, we were down 4.45% today, and the VIX instantly rejected and crushed down below 20, which is exactly what we would expect to see in a bull trend. Again, we're not getting bearish until we see the VIX close above 20 and then start to see the S&P 500 close below critical support. On Bitcoin, we're currently up about 0.5%, and Bitcoin is just chugging around this critical support zone right around 27,000. And even though we are breaking down below it, we haven't seen that high volume selling just yet, and it could be right around the corner. We clearly have the bear trend with the price action below all the moving averages and all the moving averages negatively sloping, which means we're likely coming back down towards 24,000. On Tesla stock, we were up 0.86% today, and Tesla does look like it's trying to go back into a short-term bull trend with higher lows and higher highs as long as we're trading above 183. Above 183, I think there's a great chance we go to 197 and then 200, and then it's whether or not we can break back over that negatively sloping 200 daily moving average. Longer term, this is still a bear trend because the price action is below a negatively sloping 200 daily moving average, but short term, we may be bullish above 183 to go up to that level and test it as resistance. You can instantly get more risk off if we break down below 183 because we're likely coming back down towards 173. On Apple stock, we were up 0.67% today, and we did bounce off of that critical support between 170 and 171, and we did close the gap above 173. So we can now delete that gap, and we can see price action is back above all the moving averages, and we still have the bull trend. If I zoom in, you can see this a lot easier, that price action is still breaking above all the moving averages, which means from here we could be heading back higher to close the gap below 175 and possibly even hitting that higher high breakout, which is the price target at 177. Just remember, there's no reason to be bearish in Apple stock until we break this critical support between 170 and 171, and then we will be looking for the gap fill at 167. On the financials, we were down 0.03% today, still looking like we have that rejection from 33, which could mean we're coming down to close the gap at 31, but we also have this gap to fill above 32. Just be cautious because it is a bear trend and we're still getting rejected from critical resistance, so I would wait to get bullish until we can start closing above 33. On the industrials, we're up 0.33% today, and I still think there's a very good chance we're going to bounce off of this rising 200 daily moving average and close the gap above 98, and then from there it's a question of whether or not we can bounce higher and start breaking some resistance and break out of this downtrend. On the healthcare sector, we were down 1.02% today, and we're getting way too far overextended to the downside, and we now have a gap to fill just below 129. I think in the short term we are about to see a very strong bounce in the healthcare sector, which could take us back up towards 130 to 131. We need to break through that resistance to get more bullish, otherwise we're just looking for a lower high before the next lower low. The energy sector was down 1.78% today, getting that perfect rejection from the resistance zone, and we do have a gap to fill above just below 80, but there's still a gap down here at 73, and we are in a bear trend, so there's a very good chance we're still trending lower. So jumping back over to the S&P 500, keep in mind what I went over in the introduction on how using the chart, the price action, and the trend kept us from shorting NVIDIA stock. And without a doubt, that stock is hurting a lot of bears this year that continue to try to call it top. This is why I teach you to follow the price action in the trend, because everything that's important is in the chart. We simply need to read the chart and then decide how to best trade it. There's no reason for us to have any opinions or any bias. We simply need to be objective traders that follow the price action in the trend and manage risk around the critical levels. Once you realize this is the best way to trade and the best way to manage risk, it is going to open your eyes to a whole new world of profitable trading, and you're going to really enjoy trading with this method. If you want to learn more about price action trading and get access to all of my intraday updates and analysis, come join us over at the Stocks Channel Trading Discord community. I also have my own trade alert service called Bank Trade Alerts that will send you all of your buy and sell alerts directly via email and text message, and only trades the ETFs TQQQ and SQQQ. We are absolutely crushing this market in the Stocks Channel Discord and Bank Trade Alerts, and if you're interested in either service, you can find out how to join by clicking on the links below. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.